Warren Buffett, one of the richest people in the world, has used this simple investing method to become arguably the most successful investor of all time. And in this video, I'm going to break down what his investing strategy is and how you can apply it to your own portfolios as well. Let's get to it. So Warren Buffett started investing when he was 11 years old and founded his first investing firm at age 25. Over the years, he's made a series of brilliant investments in companies like Geico, Coca-Cola, Gillette, and American Express. And today his net worth is estimated at over $120 billion. Good enough for the fifth richest person in the world, but really the only person in the top 10 who didn't actually get there by founding a company or inheriting their wealth. But how did he do it, and what lessons can we learn to apply to our own investing strategies? Well, there's two famous Warren Buffett quotes that give us some solid insights. The first is when he says that diversification may preserve wealth, but concentration builds wealth. But the second and potentially more interesting quote is when he says diversification is protection against ignorance. It makes little sense if you know what you're doing. So when trying to build wealth, not maintain wealth, but build wealth, Warren Buffett believes that concentration is the key. What Buffett's strategy all boils down to is this: understanding a handful of companies or sectors very, very well, selecting the companies out of that list that could potentially be winners, and investing a high percentage of one's portfolio into that small handful of companies. For example, the most significant investment Buffett has ever made in terms of the percentage of his total portfolio was when he put 50% of his total wealth into Geico. That was back in the 1950s, and he put half of his net worth into one single company. And obviously, it worked out well for him. But how can you apply this knowledge, this strategy to your portfolios? And is it too risky to be that concentrated? Well, the answer is it depends on what type of investor you want to be. Do you have the time, energy, and wherewithal to actually do proper research and due diligence on companies? Can you picture yourself spending countless hours actually researching sectors and fully understanding what a company is and what its value proposition is? If your answer to those questions is no, then you're probably better off to just dollar cost average into a broad index ETF over time. It's the safest way to invest and also to get a solid ROI over time. You know you're not going to beat the market, but you also know that you're not going to risk a significant amount of capital and underperform the market. And so when Buffett says that diversification is protection against ignorance, that's what he means. If an investor isn't actually able to, or doesn't have the time and energy to properly understand a company and what its value proposition is, then they're better off just investing in an index fund and being broadly diversified. On the other hand, if you see yourself as somebody that's interested in and also able to do proper research and due diligence on a company, and if you're willing to accept a higher risk threshold in order to try and outperform the market, then diversification doesn't make any sense at all. The point is, it's impossible to be an expert in everything, especially for us retail investors that don't get paid day in and day out to do research and analysis on companies. We just don't have that much time or energy to dedicate towards it. But even professionals like Buffett have huge limitations on their time and energy and aren't able to properly analyze and do research on every single stock listed on every stock market around the world. And so that's why Buffett thinks that diversification for diversification's sake is not actually a virtue, and in fact could kill a portfolio's gains. And if you're serious about investing to try to beat the market, you're better off putting your limited time and energy towards choosing a small handful of companies in a few selected sectors where you've properly understood their value propositions, you see a real opportunity, and you allocate a significant percentage of your portfolio correspondingly. To prove this point more visually, let's look at the returns of the total market over the last 5 years. You can see that if you just invested in an S&P index ETF, you could have returned approximately 92% over those 5 years. But if you invested all of your money into Google, for instance, you could have returned 213%. Or if you put your money into Amazon, almost 250%. Or if you put your money into Nvidia, almost 820% over the past 5 years. Now, I know that shows a little bit of survivorship bias, and with 2020 hindsight, of course we know that Google and Amazon would have been successful companies now, but what if you invested 50% of your net worth into Enron in 2000? Obviously, you would not be a happy person. But the idea with Buffett-style investing is to identify value where others don't necessarily see that same value. And that includes avoiding investing in dying industries, in companies that are in precarious financial positions, and so on. Now, of course, in the case of Enron, where there's significant fraud, there's not necessarily much that an average retail investor could have done to predict that that would happen. But that's the outlier. There's not really that many companies that get that big and then fail because some sort of massive fraud. And to reinforce the fact that concentration, when done properly, outperforms diversification, let's look at this academic study that was published a couple of years back that actually crunches the numbers. Now, there's a lot of technical jargon in this article, but they run something called a regression analysis over the past couple decades, and they find that concentrated portfolios do actually outperform diversified portfolios. Their final conclusion is that our evidence is quite clear that the average concentrator realizes superior returns than the average diversified portfolio. Warren Buffett has said that all you need to get rich is 3 to 6 wonderful companies. So what type of investor are you? The index buying diversifier or the concentrated value seeker? Thanks so much for watching and have a great day.